The topic today for this particular panel is really about returns and consistency of returns. As we sat around discussing this, we really think that if you boil that down, it really means what is your recipe for success. If you're able to generate returns consistently over time, it really comes down to that. And so we'll get into that, and I think we have a very interesting panel to answer that from different perspectives, given that we, as you'll hear from them, but we have a country-specific fund, we have a Pan-Asian fund, and then we have an LP who thinks about relative value across the world. But before we begin, just introduce ourselves. My name is Nirav Kachalia. I founded Canopy Group, which is a multi-strategy investment firm that invests both in public and in private equity. Heinz?
Heinz Blennemann, a single-family office based in San Francisco. And also, I co-lead ILPA's Family Office Network, which is a organization of limited partners.
David Hand from Crescent. We're a consumer growth equity investment firm focused on China and Southeast Asia.
David Doe, private equity firm focused primarily on Vietnam.
Okay, well, why don't we get started? Given that the panel is primarily private markets, we'll focus the conversation a little bit more on private, although I will ask Heinz at times to think about the public market perspective when you think about earning returns consistently in Asia. But before we get into how that's possible, Heinz, I'd like to ask you, given the environment that we're in Asia, in particular in emerging markets, where the macro environment changes, feels like daily, country dynamics across the region change daily, is it possible to earn consistent returns here?
So, consistent returns, it sort of depends on what your time frame is. And so when I think of consistent returns, I think of consistent across fund to fund to fund. So fund 1 to fund 2 to fund 3, rather than consistent where you check what the value, the private market equivalent would be every year along the way. Because as a family office, and I think many of the other LPs here, our goal is to invest for 8 to 10 years or 12 years, and over that time frame, at the end, having 2 to 3x multiples and interesting IRRs, 15 to 25% net, or whatever the numbers may be. But the consistency is more from one fund to the next fund. And there are lots of gyrations that the market goes through, and talks about tariffs and currency fluctuations along the way. But I think if you have that long-term perspective, you can you don't have as many sleepless nights. And in private equity, what the nice thing is, there's really no sell button, or the sell button is very difficult, unlike in the public markets. And the one other thing I would add is many investors, if they want exposure to emerging markets, may go into the public markets. And in the public markets, if you take a look at index funds like EEM, which is not, the construction there has flaws, but many folks think of emerging market investing as investing in these indices. Those returns have been pretty bad, and those do fluctuate quite a bit. Those are not consistent. Those are exposed to macro issues. And over the last 10 years or so, if you take a look at the returns that you've gotten from investing in an index like EEM, you're basically flat over the last 10 years, and you get dividend payouts of 1 or 2%. But and then now you can compare what private equity can achieve in comparison with that, and we can talk a little bit more later what it is that private equity does in order to get those higher premiums. But if you invest wisely in funds, in private equity funds in Asia, I think you can vastly outperform indices like EEM.
Okay, so time horizon, important, thinking about this over a long period of time. And it seems like it's fair to say that you think that having private locked up capital kind of facilitates having that long-term horizon to be able to earn alpha over a public strategy.
Yes, and so getting into why I think that alpha is there, I think that alpha is there in large part because the companies that the private equity managers choose are bottoms up. So they go in, they attract misunderstood companies and change the operations. So it's very hands-on. And these operational changes are rather independent of what's going on in the macro picture. I mean, there is, of course, some exit risk, but in general, if you increase the returns, the revenues, and the profit margins of a snack food company or a educational company, these operational improvements is what we like banking on to give us that alpha.
Okay. I want to come back to this in a little bit about your point about making these operational changes, because I would have thought that over the last several years that a lot of people were investing in Asia for the growth, right? Not necessarily for the fixer-upper type of perspective. But before we go there, as we were discussing this topic, as any smart investor should, David O had a particular opinion and perhaps a strong view on questioning the actual premise of consistent returns and the idea of that. David, do you want to elaborate?
Yeah, I think couple points with respect to consistency. So if you're looking at Asia or emerging markets in general, there's a classic consulting curve where it's an S curve where you see GDP per capita. So your ability to deliver consistent returns is a function, a large part of where you are in terms of GDP per capita. So for example, if you reach 3,000 in GDP per capita, you often see a lot of intra-regional travel. So once you reach about 7,000 in GDP per capita, you will see people traveling to other continents. So if you were investing just in intra-regional travel, so for example, in Southeast Asia would be just investing in Bali or Phuket, and then your market got wealthier, then you wouldn't be able to deliver those returns because the growth rates aren't the same. So I think that's the first point. I think the second point is on a year-to-year, mark-to-market basis, particularly for the more frontier side of emerging markets, it's very difficult to deliver consistency because the macro factors. If we look at our own performance, the cash on cash and the IRRs have gotten better with say the second vintage from the first vintage. But the reason why that happened was, we had the good fortune of closing our fund right after Lehman died. But even though we put capital to work when valuations were cheap, there was no exit market for the next 4 years, particularly for our market, because globally, within the region, everyone was trying to repair their balance sheet. So even though we had bought well, we couldn't sell because nobody was buying. Emerging markets were out of fashion, so the IPO market was closed. So the way we try to deliver consistency, because to a certain extent, LPs when they evaluate fund managers, they have to benchmark returns. We try to be a lot more thoughtful about how we've made the money. We also try to make sure that we don't get write-offs. And really, in a high-growth market with low leverage, you shouldn't be getting the write-offs. So we think of consistency probably a bit differently from investors who are just who are looking at both public and private markets.
Okay. Well, why don't we take a stab at understanding better some of the levers that each of you do utilize to try to kind of create this. Again, I'll stray from the word consistency, especially given the points that both of you have made, but towards kind of creating the success that you each have had thus far in your respective vehicles. David Hand, you've been investing for 15 years, been returning capital quite consistently over that period of time. What would you say are some of the most important drivers of that for you?
Yeah, so I would say that, first off, the reason why you would come out here to invest in Asia to begin with is you want access to growth, right? That's why you invest in China. That's why you invest in Southeast Asia. And so I think that, off the bat, as an investor, you're looking at those sectors that are going to deliver you the most consistent sectoral growth within these markets that are already growing above global GDP growth, and then within that, trying to find the best companies, right? The consistency point, and I echo something that David Doja said. I think for us, what we think a lot about is how to avoid big mistakes, right? So you can, do your best to find the best companies and to find the best companies within your target sectors. But then you need to use, I think, because we also don't use leverage, and leverage is pretty uncommon in companies out here, at least in the growth stage, we use a lot of structuring tools to avoid big mistakes. So we use things like performance guarantees, we use things like redemption features, we use things like different types of preferences, but really structuring intensive to make sure that if things don't go according to plan, you have some of these features that can limit your downside. And I think that if you do that, markets may close, markets may open, but as long as you're avoiding really sort of running into major potholes along the way, I think that over time that will give you the best way to achieve sort of, avoid the mistakes and achieve sort of generally above trend returns.
Right. So takeaway, which it's been interesting, it's an interesting conclusion, which is that, at least historically speaking, there's been so much growth that kind of takes care of itself as long as you're playing in the right subsectors within these economies, and protect your downside and let the growth kind of take its toll so that you'll make your return. That's
right, yeah, because I think as well, if you're investing in growth businesses, these are typically entrepreneur-driven businesses. The people that are running them are the right people to be running them at that stage, and you're really trying to give them capital to help them grow, help them in ways that you can assist. It may be operational, it may be strategic, whatever, but to a large extent, that sort of takes care of itself. It's when
Sure.
things go wrong, whether it's company-specific, whether it's country-specific, whether it's sector-specific, that's when a lot of these downside protection tools come into play.
Got it. And so for the sectors that you think that you're playing in, at least for the foreseeable future, do you believe that the growth will continue, and so this strategy for the next 10, 15 years, or at least for the next 5 years, is still applicable in the same way?
Yeah, I think so. I mean, I think that, I said earlier we're a consumer growth equity investor. The reality is within consumer, we have 6 sectors that we focus on across regions. So we invest in China, across every major Southeast Asian economy. And I would say within those sectors, I mean, for us, we selected those sectors, travel being one as an example, because we feel like within those sectors, there is a consistently more consumers that are using those types of products and services as their disposable income gets above a certain level. And as it rises, they upgrade their consumption over time. And I think that in these markets, obviously, Vietnam is at a different stage than in the Philippines than is with China. Every market is different, but I think the trend is the same. And I would say for the next 5 years, for the next 10 years, I think all these markets, that story is intact.
Yeah, and one other point, you think about China, you think about Southeast Asia as well, is the ability to think about the entire or different geographies within the continent, is that a lever for you as well in terms of helping you provide or trying to generate consistency?
Yeah, I think for us, what you see over time as well, we're quite price sensitive, and aside from the structuring, and so I think you see at times certain markets, Indonesia 4 or 5 years ago, certain parts of Chinese consumer now, particularly around tech, or certain stages where you see valuations generally get stretched. And I think our ability to move within the different sectors or move within the region, I think allows you to sort of stay away from those sectors that are generally overvalued. And ultimately, obviously, where you buy into one of these things makes a big difference on what your returns look like.
Okay.
So I think that that's true. And I would say as well, I think that, to me, I think that going forward, part of the question was about inter-regional activity. I do think as well there's increasing amount of kind of convergence between China and Southeast Asia. There's a lot of Chinese companies investing in Southeast Asia. There's a lot of Southeast Asian companies that want to access technology, commercial counterparties, whatever it is in China. And so I think that as well going forward, you will see more convergence among these markets.
That's interesting. Sure. Hi.
Just to add to the comments that were made here earlier about why Asia is so interesting in terms relative to the West, one is the growth, I agree, and Mark Yusko, who we know well, he has this really nice explanation of just to kind of put a mindset around how large the growth, the GDP growth of China is. So if China continues on its current projection for the next 2 years, or the next 3 years, so up to the year 2021 roughly, it's the increase in GDP will be larger than the two economies of Germany and Great Britain combined. So the absolute
Sure.
size of those two. So it's just mind-blowing how much how a change in the GDP of China translates to in absolute numbers.
Right.
So that there's a big
It's
swell.
unmistakable. It's a large market.
And the second thing, which I think is interesting, Asia versus the West, is that the types of structuring that David, for example, is doing, David Hand, is that that type of structuring is very difficult to do in American companies, right? In order to get the downside protection using where you can put your equity back to the company you invested in, that sort of structuring you cannot do in the United States. I don't think companies that would take your money would agree to those types of terms. But here in Asia, it's easier to do that kind of structuring. Was that correct?
I mean, I believe that to be true. Yeah, definitely.
So I think that's another advantage of being able to invest in a country where capital is more dear.
Sure. So better terms to some extent, although I think we'll come back to trying to contrast and compare some of the benefits of investing here versus the West. And it's a big market, so generates lots of opportunity. David Doe, you have a very different perspective than David Hand, right? You're investing in one country. How, given that framework and context that you're operating in, what are the levers you're using to kind of create this recipe for success over a long period of time?
Yeah, I think the first one is what Buffett says, whereas the thing you can control is not to invest. So when things are exuberant, which they are right now in Vietnam, for example, we just don't jump on the same bandwagon because we've lived through a couple of cycles. I think the second thing is we've become specialists around sectors, and then through our prior investments, we've built critical mass in terms of operating businesses so that we have the ability to do kind of bolt-on acquisitions or bolt-on investments and get them operationally better, quicker. So, the more time you spend in a market, your ability to source deals increases because you've pretty much looked at everything after a certain number of years. And then it's really a question of waiting till the circumstances are right to make the investment. So that's the first thing. And then secondly, we've had the luxury with a relatively low cost of labor of being able to build up a very large operations team. And so increasingly we've done more and more control deals because it just allows us to drive the value realization part quicker. Because one of the other things we've learned is if you're doing exits to strategics, what the strategics are buying is market share. They want to enter a market. They want to buy something which is the top, a top 3 player. So if you're going to invest in something, you've got to be pretty sure you can get to be top 3 by having bought well, bought somebody who's already big or improving them so they get big or bolting on a few things so you get that scale.
Got it. And do you think finding talent, given the operational focus here, is finding talent easy, not easy? How do you vet it? How deep is the bench, especially as you think about taking control positions? Because I think David Hand alluded to it earlier, that one of the reasons he's in the business is backing great entrepreneurs, right, who understand their environments intimately well.
Yeah, I mean, I think if you look at our returns, if you found the best entrepreneur and they're aligned, the returns are better than doing it yourself. There is no question empirically. The problem is, they may not be at scale or the timing may not be right, and you can still get good returns if you assemble management teams in businesses that you know. I think the challenge for us has always been getting middle management because the population is too young. There's just not enough people who've grown up with experience or who've grown up and been handed bigger and bigger P&Ls to manage. And then the other issue is retention, because there's so much interest. Each new strategic that enters the market, or regional firms will pay more for talent. So retention is definitely a big challenge.
So you would say that one of the learnings or so in the evolution of your strategy over time, and what do you think one of the key drivers of the success now is having control positions, because one, strategics are perhaps an easier exit path than an IPO market, and then two, because if you're a strategic, you really want to own and control the underlying business and opportunity set, and so that's a key piece of the success today.
Yeah, I mean, when you're country only, you've got to have both the IPO and the strategic option available rather than just waiting, because the IPO window doesn't open very often in smaller, less liquid markets.
Right. And do you think, again, coming back to the time frame, do you think that, given the stage perhaps of the evolution of Vietnamese economy today, you need to think about holding businesses longer because you're really helping them build over time? Or do you think that there's, it's the hold time will shorten, dramatically as given the heat of the market today?
So I think if there's anything we would do differently, we probably would have held the winners longer, because we may have made the 10x or the 15x, and then somebody comes along and makes a 3 on top of that. So why give that to somebody else? I think if you look at Asia, how many countries have made it into the first world, right? You've got predominantly North Asia and Singapore, so you've got Japan, Korea, Taiwan. If you look at the remaining countries, you've got to get rich before you get old. I mean, it doesn't look like China's going to get there just because of the sheer population. And then if you look at what's left in Southeast Asia, you've got Malaysia. Doesn't look like they'll get there for a number of reasons. Thailand probably won't get there. Because Vietnam is earlier in the GDP growth cycle, we probably still have 15 years of growth, but it doesn't mean that you need to get to first world to make the returns during that period where GDP per capita is growing. Haven't thought about what happens if after 15 years and doesn't look like we'll get to first world. That's tomorrow's problem.
Yeah, of course. So Heinz, we've obviously heard from both these guys about what has made them successful up until now. And we all know the disclaimer about how historical track records cannot be used to predict future returns. As you're thinking about this, your job is to help go find great new managers, right, who will hopefully kind of create success for you consistently over the next 10 years. What are some of the key indicators for you today, given the macro environment, and I think we've heard throughout the conference a little bit about that we're perhaps entering a new paradigm in the world, right, which clearly affects Asia as well. So what are some of these key indicators for you?
So one of the things I look for is a fun characteristic, which is I really like sector specialists. And we actually had an interesting session on that yesterday, kind of debating the pros and cons of that. But the reason why I like the sector specialists is whether it be a country specialist, like in the case of David Doe, or in your case where you look at deep value investments, regardless of where you find them, but they're deep value in Asia. I find these types of strategies much more interesting to me because and Cambridge has made some studies on this as well. You get extra alpha by being a specialist in something, excelling in something, and then rinse and repeating that structure. Some people might make the argument that if you're a generalist, well, if there's a cyclical period, then you might be forced into buying into an area that is not doing very well, just simply because that's your specialty. But I would argue that being a specialist just outweighs it because that problem, simply because there's so much synergy you can get by knowing how to structure things and repeating that, or by understanding Vietnam inside and out and knowing where the growth companies are within the big economy. So that's just something I like. I prefer sector specialists over generalists in doing this. So that's one of the things I look for.
Okay, repeatable skill set. I think there are a lot of China growth who've just accessed companies that may not work over time, just as valuations creep up, right? So, but it's got to be a specific skill set that you can tangibly buy into.
The other reason why I like specialists is because as an LP, I want to know what I own. If I'm investing in a fund that's a generalist, they might end up investing in railroads or in restaurants, or I don't know. There's very little predictability. You're giving somebody a blank check for 10 to 12 years. Whereas if I'm investing in a Vietnam fund, I know I'm going to be in Vietnam. If I'm investing in deep value, I know Crescent Point will be looking for deep value opportunities as long as I'm invested.
Got it. And one thing that we discussed, again, as you think about the future, are there alternative structures that may, again, David Doe has talked about a longer term hold. Are there alternative structures that you're thinking about that actually would truly facilitate, consistency of returns?
So another set of funds that I like are the infrastructure / specialty finance types of investments, and particularly infrastructure. And the reason why I think infrastructure is very interesting because there are some funds that do Chinese parking garages, Indian warehouses, Indonesian warehouses. What's nice about these types of infrastructure investments in Asia is that you get payout because of rental income along the way, and then there is a residual value at the end of this investment so that you can afterwards maybe get 2 to 3x on an investment where all along the development cycle there is a hard asset underlying your investment.
Sure.
So I think infrastructure is also an interesting place to invest in Asia.
Okay, great. In the last couple of minutes here, I just want to turn it back over to David Han, David Doe. If you don't mind spending a couple of minutes each, just giving us your view on look, the world as a global investor is a relative value game, right? So everyone has alternatives of where they can invest or not. As you think about the ability over the next 5-7 years to earn a great return consistently for your investors, and given that I think uniquely you two have a lot of experience in the West as well, what do you think, if you could give a couple examples of comparing, contrasting what's easier or harder about investing and generating consistent returns in Asia relative to the West? I'll let
Sure. I can go first. I think there's definitely less competition here. I've done a lot in the States. You have people who specialize by geography, by deal size, who are on Fund 10, who've done the same thing. It's very rare to find people past like Fund 6 in Asia. So if you're truly a specialist, I think you have the edge because there's not a lot of specialists running around. I think Asia has shown there's potentially an investment model slightly different to developed countries, where if you have an ecosystem, Meituan priced their IPO this week, I think, in Hong Kong. You've seen the big three in China. We see some of that in our market, where and I guess in a developed market, Amazon is proving that if you can get scale in terms of users and build an ecosystem around that, that model works well. If you can find something like that to invest in and ride it, for a long period. And then I think one other challenge that you face in Asia is you just don't have that many good advisors. You've got bankers available everywhere in the States, probably the most overbanked market. I think the advisory market here is difficult for a couple of things. One is, in a lot of Asia, you have strategics which are controlled by families. The families, the first generation, they're used to kind of the consigliere model, a trusted advisor. The children have been educated in the West, so they're more used to dealing with kind of the Goldmans of the world. And then kind of in the mid-market and smaller deals, you have very fragmented advisor base. So if you're trying to trade sale something, you often have to develop that capability yourself and go find your exit, because it's not such a well-banked market.
Got it.
Yeah, and I would say that I think that the advantages you have investing out here, and we talked about growth a lot already, and I think that that's, again, why you invest in this part of the world. I think the other thing is that, there's an incredible amount of innovation, business model innovation, for example, happening in these markets, where you have entire industries being built over a relatively short period of time, or with ecosystems in China, like the WeChat ecosystem, completely new business models that don't exist anywhere else, springing up over a matter of a year or two. And I think that you really just don't see that anywhere else. I mean, maybe you see it here, maybe you see that in Silicon Valley, but other than that, there's nowhere else where there's a similar kind of just incredible value creation that happens in a short period of time. I would say that the primary challenge, I think that or two challenges, I would say. One is exit markets. So as David alluded to before, I think IPO exits are much more difficult in the smaller markets. I think for Chinese companies, it's easier to do, obviously, an IPO exit than it is in some of the Southeast Asian countries. But even there, the IPO market opens and closes. And I think if you aren't open to possibilities of other exit routes, you can find yourself stuck in companies for a long period of time. Whereas in the U.S., you have financial buyers at all different sizes. There's a lot of debt financing available. So there's always that secondary sale opportunity. And I think that and probably the other thing in Southeast Asia primarily, although we've seen a little bit of this in China recently, is FX as well, right? For US dollar investors, you have to be very concerned or focused on or aware of FX moves, particularly in Southeast Asia now. In China, you've seen the RMB go from 6.4 to 6.9 in a matter of 4 or 5 months. So if you aren't aware of that and you aren't pricing things or thinking about that risk in your modeling, that can eat into your returns, which obviously you don't face in the U.S.
Sure. Okay. Thanks, guys. We have just a little over a minute left. Any questions from the audience?
Can you speak about, let's say Vietnam, from a dong return versus a dollar in your last fund or two?
Yeah.
And maybe for you, David, you pick a crazy currency place like Indonesia on a rupiah versus a dollar, how that compared?
Yeah, so the way I would answer that is what are the returns pre-trade surplus? So we've been running a trade surplus since 2011. So currency devaluation has not really been an issue for us. Before that, we had a trade deficit because there was a lot of investment in factories and things like that. We did convertible debt in US dollars, but fund returns were still impacted by probably close to 15%. So, you know, currency probably devalued 35%, and we were impacted by about 15 because, you know, we were able to do a number of deals in you know, through convertible debt. But, that, you know, I think if I'm, and I'll leave it to the expert, if I'm in a country which has a trade deficit right now, I'd be a little bit worried because we lived through that time, and it's, you know, hedging costs are very high for, you know, for smaller currencies.
Yeah, I mean, I would just add to that. I think that, like David, the structures that we do, particularly in Southeast Asia, tend to be U.S. dollar denominated. Ultimately, you know, for some of those businesses, you are taking at the point of conversion, like we'll do typically like U.S. dollar convertible securities that you eventually convert into a local currency. So you're taking, in effect, the FX risk from that point forward, right? You end up with a bigger percentage of the company if the local currency devalues. But it is true from that point forward, you're naked, and I think you have to just take that into account when you're thinking about what kind of return you're targeting, because it is prohibitively expensive to hedge in those markets.
I mean, we like a couple of businesses where you get a natural hedge, so travel, because, you know, it effectively is priced in dollars. Logistics, you know, we don't do oil and gas or energy, but, you know, that's typically priced in dollars as well.
Okay, I think we're out of time. So thank you for joining us this afternoon, and thank all of you for spending time giving us your thoughts.